We're talking about the presidential cycle and the stock market with Bob Gorman. Hi, Bob. How are you?
Fine, thanks. Good to be here, Howard.
Good to have you. Bob, you've done a lot of work on the presidential cycle. I know a lot of market historians focus on that, technically oriented people. What does the calendar tell us about where the market is going?
Well, you've got a few key factors. If you go back to 1928 and look over the next 80 years, you find several key points. And the first of them is that if you divide the term into its two halves, years 1 and 2, years 3 and 4, performance is markedly better in the second half. Years 1 and 2 in combination have returns of about 8%. Years 3 and 4 in combination, 22%.
Wow.
So dramatic difference.
It's almost 3 times.
It is. It's quite remarkable. So we're close to the end of year number 2, approaching the second half, which generally performs much better. So
is there any reason for that? Is it because like the presidents tend to be so ambitious in the first half of their terms and Congress tends to do more and does less and investors like it when Congress does less?
I think you've touched on it. Investors hate uncertainty. A new president at the peak of his popularity generally strives to push through the legislation that will represent his legacy in the first half of the term. So you have very, very activist legislative agenda that creates a lot of uncertainty that investors generally don't like. In the second half of the term, you generally have a better balance of power between the president and the White House and the opposition, which has gained strength after the midterm elections. Investors like that a lot more, and the second half performs much, much better.
Now, does this hold when you have both Democratic presidents and Republican presidents and Democratic Congress and Republican Congresses?
The general thrust is the same, but there is some difference in the numbers over time. The best combination historically has been a Democrat in the White House and Republicans controlling the Congress. So it's a small sample size when you take a look at those sorts of numbers, but that is the historical pattern.
So how does that fit in with where we are now?
Well, at the moment, we are close to the end of the second year. We're heading into the third. And the third, by the way, is the best single year of the 4 years. From 1928 to the present, in the third year of the presidential cycle, the average return has been 14.1%. And it's been remarkably consistent. Of the 20 years over that period that have represented the third year in the cycle, 18 of the 20 have seen an increase in the third year. The 2 times it didn't happen, 1931 in the Depression and 1939, the outbreak of World War II. So the stock market's not gone down in the third year of the cycle since World War II. The fundamentals, of course, are always paramount, but this is something very important to bear in mind.
So basically, with the caveat that we can't know for sure that the future will replicate the past, in general, this pattern has worked fairly well over time.
In general, yes, and it's also worth noting that the magnitude of the move in year number 3 often reflects the magnitude of the change in the electoral landscape. For example, in Bill Clinton's era, the Democrats were overwhelming in their power from 1992 to 1994. In 1994, they incurred their biggest losses in the House since '46, losing 54 seats. This brought about a dramatic change in the political environment, and next year, 1995, the S&P 500 went up about 34 points, one of the best years in history. This year, we're probably going to see a marked change in the political landscape, and that could be a positive portent for 2011.